M&A is not one word. A merger is one of equals. A merger happens when two firms, often about the same size, agree to go forward as a single new company rather than remain separately owned and operated. Mergers are often rare these days. They involve an exchange of stock rather than cash. A good example of a merger is one that is Daimler-Benz and Chrysler. An acquisition is when one company acquires another company, when one company takes over another company and clearly establishes itself as a new owner. The purchase is called an acquisition. It's more often than the case these days, and this happens when the one company buys the entire stock of the other company. Tata buying Jaguar is a classic example of an acquisition. As I've said, the example of a merger can be Daimler, Benz and Chrysler when they merge to become Daimler Chrysler, and Tata buying Jaguar. To understand the drivers of M&A, we need to go back to the reasons why companies exist in the first place. Okay? Take a company like Facebook. It can either remain the same and continue to be a $153 million company with a $138 million loss, as it was in 2007, or it could be a $27 billion company with a $10 billion net income. What's changed? Companies are driven by two guiding principles. The first one is to increase sales in a sustainable manner to perpetuity. Perpetuity means that there is no finite life to a company. A company is an ongoing entity. Companies exist long after you and I depart this world. In fact, the oldest company in the world was created in the year 705 in Yamanashi in Japan and continues until today. The New York Stock Exchange was created in 1792 and is very much an ongoing entity. Dixon has been making pencils since 1795. And then there is the bottom line. A company has to also create a profit. Why? Well, without a profit, it cannot put money back into the company to expand capacity, which will help it meet its first guiding principle. So a company, in a sense, has two guiding principles: to grow both its top-line revenue in a sustainable manner year after year till perpetuity, and its bottom-line profits year after year in a sustainable manner to perpetuity. But how do you do that? Companies grow using two major vehicles. Let's go sit in on Samrat Bazar's latest strategy meeting. Mr. Samrat, the company's MD and CEO, responsible for strategy and growth, Mr. Jacob, the company's CFO in charge of the company's financials, and we have Ms. Sunanda, who's the COO in charge of all operations. The company is a multi-brand hypermarket chain with over 20 stores across Maharashtra. They have grown well, but in today's meeting is to understand why their growth has plateaued between 2015 and 2016. They know they need to add more outlets and expand geographically. Ms. Sunanda says that it's possible to expand geographically in a new market, but it would take a minimum of 8 months to find the right real estate, hire local staff, and create a network of local vendors in unfamiliar territory. This strategy is called organic growth. Organic growth is the growth rate a company can achieve by increasing output and enhancing sales internally. How could they possibly grow faster, asks Mr. Samrat. 8 months is slow, and it's quite certain their competitor, Bigger Bazaar, is going to be opening stores in the next 4 months. But Mr. Jacob says, why not buy the local hypermart Kvars and jumpstart the process by at least 4 months? This way they can get access to local staff and vendors. Mr. Samrat nods. This strategy of buying Kvars instead of building their own stores is called inorganic growth. He looks at Mr. Jacob and asks him about funding. Mr. Jacob says they could use internal resources or cash available in their retained profits, but it's unlikely to be enough. Regardless of whether they buy Kvars or put up their own stores, their internally available funds will not be enough to fund their expansion. Mr. Jacob replies that there are 5 major ways to fund this new endeavor. The first is to raise debt from a bank in the form of a term loan. The second is to raise equity funding into the company by selling a percentage of the firm's equity to an outside investor. The third is to go public and raise equity from the markets through an initial public offering and in a rare case, spin this operation off as a separate entity and raise money into the project as project financing. Mr. Jacob, however, goes on to say that in the event they choose the route of an IPO, it would mean they would become part of the equity capital markets and be subject to monitoring and rules set aside by the SEBI. Their stock would be tracked on a quarterly basis and they would have a fiduciary responsibility towards their shareholders. Mr. Jacob also adds that it doesn't matter if they choose inorganic or organic growth, both would have to be funded and can be funded using any or all of these options. So in summary, there are two vehicles of growth to ensure sustained revenue growth and sustained profitability for an ongoing entity. They are, you can either make, which is organic growth, or you can buy, which is inorganic growth. That Mr. Samrat realizes the first choice would be to decide if they want to choose the organic route, make, or the inorganic route, buy. The first step would be to do a cost-benefit analysis to understand what each route would cost. But money is not the only factor when deciding whether to make or buy. While money would of course play an important role in deciding whether to make organic growth or buy inorganic growth, there are many other factors that are just as important. Here are the advantages and disadvantages of inorganic and organic growth. Every company loves to see growth. It's a signifier of potential success and that things are working within the organization. However, not all growth is created equal. In general, growth is considered either organic or inorganic. Organic growth comes from expanding your organization's output and by engaging in internal activities that increase in revenue. Inorganic growth comes from mergers, acquisitions, and joint ventures. What are the benefits of each type of growth, and what type of growth do most investors prefer to see? Since organic growth occurs in a relatively tighter-knit organization, management knows the company's strategies and operations more intimately than an organization that has recently undergone a merger or an acquisition. This means the company is typically able to adapt to changes in the marketplace more quickly. There's less integration challenges and restructuring. During a merger or an acquisition, there's typically restructuring of personnel and operations that occurs to manage the new volume of business. This can often mean layoffs, changes in the leadership team, and overall figuring out how to monitor more employees and assets. During organic growth, integration challenges or management personnel changes are typically more gradual, which can feel more comfortable and natural for the internal culture. Without merger or acquisitions, entrepreneurs have more control over the direction the business is headed. It's more sustainable. Sustainable growth is the ultimate goal of any company. Without organic growth, there's no investor interest, little possibility of becoming an acquisition target, and virtually no chance that the company will become vibrant enough to sell. Bringing in consistent or growing revenues is a sign that things are working within an organization and is an important step in business success. Now we come to the cons of organic growth. Growth can be significantly slower through this strategy. Since there's no infusion of market, product, assets or resources, companies growing organically must do so at a sustainable pace. This means growth can't overshoot personnel, support and resources available. This may also decrease your competitive edge. We all know that the best way to succeed in an industry is to outplay your competitors. If your competitors are growing quickly or if your industry has high M&A activity, then growing too slowly can mean you'll be quickly overtaken by competitors. This is called a glass ceiling. Businesses that rely on organic growth often find that they lack the resources to continue to grow in a way that allows them to achieve their goals. As businesses and customers' needs grow, receivables and other cash-consuming items and resources grow as well. Competition drives the market. M&A activities like dominoes. Once companies in an industry begin merging, it puts the heat on all other companies to grow more quickly than is organically possible, or they may be left behind. Competitors' influx of resources and businesses may allow them to lower prices or employ other tactics to steal market share, making it more difficult for smaller companies in the industry to grow. Which brings us to the advantages of inorganic growth. Growth is much faster when you follow this strategy. According to QuickBooks, many businesses nearly double or triple their client list with a business merger. Since this growth occurs through a transaction, this inorganic growth is much faster than is possible during organic growth. Another pro of inorganic growth is that companies gain an immediate increase in market share. One of the greatest benefits of a merger or acquisition is the increase in market share. Through inorganic growth, you are gaining the benefits of an entire company's prior sales and relationships, which means you are immediately gaining markets and clients you otherwise may not have had access to. Inorganic growth also increases knowledge and experience. By combining your company's forces with those resources of another company, you are gaining the knowledge and the expertise of their key players. This increased knowledge and experience means you have a stronger round table in making strategic decisions moving forward. Another pro of inorganic growth is that you create a stronger line of credit. It can be easier to take on debt financing after a merger or acquisition, as some inorganic growth results in a stronger line of credit with the combined value of two businesses. Inorganic growth also lends a competitive edge in the market. Your newfound resources, assets, and market share means that if the implementation goes well, you will be a force to reckon with in your industry. You are setting a new pace for growth that can push you ahead of competitors and give you a strategic advantage in pricing, purchasing, volume, and overall reach. Significant upfront costs. Funding a merger or acquisition usually means a sizable upfront cost. If your company doesn't have the cash on hand, you will likely have to rely on taking debt, which can make the merger or acquisition less attractive to investors. If the integration doesn't go well, this could also mean a lot of debt that you're suddenly unable to pay off. The sudden growth from a merger or acquisition generates complexities associated with properly scaling operations such as systems, sales, and support. Without proper management of growth, a merger or acquisition's roots won't be able to take hold and the integration will ultimately be unsuccessful.